From our studios in Atlanta, this is CarBiz Today.
The Kerrigan Advisors Market Update, brought to you by Kerrigan Advisors.
Hello everyone and welcome into the Kerrigan Market Update. We're joined now by Ryan Kerrigan, the Managing Director of Kerrigan Advisors. Thank you so much for joining us.
Bridget, great to be with you as well.
So Ryan, let's start off with the Kerrigan Index for August. How did the publicly traded auto retailers do in August?
The Kerrigan Index was up just slightly, 0.26% for the month of August, compared to the S&P, which was up about 3%. Year to date, the index is up 5.6% versus the S&P, which is up 8.5%. Sonic, Asbury, Group 1, and CarMax were all up between 4 and 5% for the month, while Lithia was down a considerable 16% in August. Note, however, Lithia is giving back some gains. They have been up the most in the last couple of years.
The publics have been posting some solid profits, though?
Yes, they have. Each posted very strong second quarter profitability. Profits were up year over year, ranging from AutoNation, which was up 11%, to as high as Sonic, which was up 39%, and Group 1, which was up 44%. So profits and general business performance remained very strong.
And what's driving these profits?
Well, a couple of things. Certainly tax reform passed at the end of 2017 has helped a lot. But another big driver is F&I. The publics have been very focused on improving F&I gross margin. 5 of the 6 publics posted positive F&I year over year, averaging up 5% F&I gross. And that really just drops right to the bottom line.
Shifting to transaction activity, does the market remain strong?
Yes, transaction activity does remain quite strong. Transactions were up 14% in the first half of 2018 versus 2017. The publics increased their spend 9% on acquisitions here in the U.S., spending $481 million in the first 6 months of 2018. That said, it's also worth noting the publics like their stocks a lot at these prices. They almost doubled their share buybacks to $309 million so far this year. That's the biggest shift in how the publics are allocating their cash flow.
And large platform deals are still getting done?
Yeah, deal size continues to get bigger, and multi-franchise transactions are really becoming the norm in auto retail. Multi-dealership transactions are up almost 50% to 33 transactions in the first half.
Which franchises are hot?
Let me answer that in a couple of different ways. When you look at transaction activity by brand, GM, Ford, and Chrysler remain the most traded franchises. First, there are lots of them, and many buyers are attracted to the high ROI. Given that, domestics have the largest market share, followed by imports and then luxury. But when you control for the number of franchises in the system, the import luxury stores actually turn over the fastest, 2.2% in the last 4 quarters. And domestics actually have the lowest turnover when measured in proportion to their dealer body. So the takeaway here is that virtually all the OEMs are quite healthy, and there's active transaction activity across all brands.
How are rising interest rates impacting dealers?
That's a great question, and we're really starting to see this play out. We've been talking about rising interest rates for quite some time, and now it's here. For the first time, we've seen interest expense on dealership P&Ls in contrast to interest credits that we've been seeing for many years. So that historical anomaly has now come to an end, and dealers need to start evaluating their business plans so as to trim interest expense. For starters, as many of the public CEO and CFOs have said recently, it's time to really start looking at your inventory policies. We recently completed a sensitivity analysis for rising interest rates on dealerships, and holding all other things constant, we estimated the interest rates rising just 100 basis points, that is 1%, could bring down the bottom line of your average dealership down 18%. The good news is that all other factors need not be held constant, so dealers need to start evaluating their operations and finding ways to overcome the impact of higher interest rates.
And interest rates play a big role in real estate markets?
They certainly do. We anticipate that we'll start to see cap rates starting to creep up, although they've certainly held steady for quite some time. As this happens, rising interest rates will start to push down real estate values, and this is really significant for dealers because on average, real estate is the largest component of the value of their businesses.
You've spoken about Canadian dealership groups coming into the U.S. Is that still continuing?
Yes, we do see that continuing. The U.S. remains a much larger and more fragmented market, and we're seeing Canadians and others looking in the U.S. It's interesting that Canadian dealerships are trading at higher multiples than their U.S. counterparts these days, and we think this has something to do with the supply and demand of available franchises in Canada.
And outside capital continues to play a role?
This is something we're going to be talking about for a long time. Our market is consolidating, although it will take some time. The family balance sheet is simply not big enough to play meaningfully in this consolidation game. Good, well-run platforms are going to increasingly tap outside capital to fund their business plans. This is something we're spending a lot of time on and engaging with some very deep-pocketed and impressive sources of capital.
What do these outsiders find so attractive?
For starters, our industry has a long history of very high returns on capital. Good, solid operators have been able to generate very strong profitability through good cycles and through bad cycles. Additionally, with change in the air, outside capital sees a chance to participate in a period of rapid consolidation. They've seen this kind of opportunity before in other industries, and they're starting to see it now in automotive retail. It's also worth mentioning there's some remarkably attractive assets and platforms available, and these opportunities do not come up all that often.
We haven't talked about tariffs and the threat of a trade war. How is that impacting the market?
Frankly, we're not seeing a lot of impact in today's buy-sell market. It doesn't mean it's not real or not important. We think this is a real issue, and certainly depending upon which brands we're talking about, the outcome can really differ. Senior OEM executives tell us they believe that tariffs are quite likely, and they're busily adjusting their business plans and trying to mitigate the impact. So while the expectation is while this gets worked out in the longer run, this could have some very significant impact on OEMs and dealers in the short term if the Trump administration follows through. You can see on this chart here which franchises are most impacted by tariffs.
So a dynamic marketplace.
Yes, it is dynamic. This headline caught my eye the other day. Here you have Ford, which has had such a strong run and been highly profitable through these good years, but just a couple of operational missteps and the perception they're lagging a bit on technology, and their debt has been put on watch for a downgrade to junk status. Recall, this is a company that remains highly profitable. They just posted $1 billion in second quarter profits. To me, this is a perfect example of the fast pace of change in today's automotive sector. The good news is that auto is hot, and we've become the focus of Silicon Valley. The trade-off is that change comes fast, and we need to be on our toes.
Well, Ryan, thanks so much for joining us and sharing with us the Kerrigan Market Update. We look forward to talking with you again next month.
Thank you, Bridget. Good to talk with you.
It's Thursday, so be sure to catch today's episode of Kane & Company with David Kane and Hard Truths with Dave Anderson. They're available exclusively right here on the CBT Automotive Network. And while you're here, be sure to check out the all-new September edition of Car Biz Today magazine featuring Alabama head coach and car dealer Nick Saban. That's it for us today. Don't forget to follow us on social. You can find us on Facebook, Twitter, YouTube, and LinkedIn. Thanks for watching, everyone. Make it a great day. We'll see you right back here tomorrow.
CBT Automotive Network, the #1 most watched network in retail automotive.